Uncertainty. I think that's the word for the day. I think on Friday, everybody was 100% certain about the 25 basis point interest rate cut coming from Powell and friends. But over the weekend, I think that certainty became slightly less so. Maybe you could call it buyer's remorse. Anyway, a lot of Fed presidents are speaking this week, and Fed governors, in fact, two are speaking later today. And those will give us further hints. And at the end of the week, we get the PCE. That'll be big. And everybody, of course, is paying a lot of attention to the Nvidia earnings call, which comes after the close tomorrow. So things were going down earlier this morning. But then breaking news, some housing numbers came out, and they were really pretty good in terms of what the Fed might be thinking right now. We'll get to those later on in the show. All right. You heard it here first, but it bears repeating. I'm going to say this again and again. Elon said over the weekend he has a plan, specifically says, I have a plan for that, meaning the massive advantage right now that China has with regard to the United States, or compared to the United States when it comes to energy production, in particular excess energy production that can be used to build AI data centers and to power those data centers. And that's going to dramatically impact the AI race, which is a lot of what our book is going to be about, and which is a lot of what Elon Musk has been talking about for a while now. This is critical, critical, critical. You've heard it all. It's not a surprise. I'm telling you right now, Elon is going to open up a gigafactory. He talked about this earlier this year. I'm going to continue to say this. He's going to open the gigafactory to make solar panels, and he'll likely use those solar panels in some combination with megapacks, and he's going to create massive amounts of energy. And the energy that he will be making will be used, first of all, for internal use, including charging stations for cars and trucks. Remember now, it doesn't matter where the energy goes. You see, we just need more, okay? So it doesn't have to be next to a data center. It can be on a rooftop. It can be, in a backyard. We just need more of it. And that's what he's going to do. He's going to provide tons of additional energy. It's going to be a massive amount. So he's going to use it, first of all, in terms of our company, in terms of Tesla, the one we care about. He's going to use it, first of all, for internal uses like charging stations for both cars and trucks. He'll use it, for factories. He'll use it for customer use, particularly for charging trucks like Pepsi, that kind of thing. He'll use it for XAI data centers specifically, just like he's already got, I forget how many acres up there near Memphis that he's going to be using for that. He'll use it to create Tesla-owned utilities. I'm guaranteeing you that's going to happen. And then he'll sell it to anybody that's willing to pay for it. So that's going to happen. Just count on it, and it's going to be a massive profit center. It's going to be big, big, big. Now, it's not going to be humanoid robot size, but it's going to be an important. CERN Basher this morning talks about another set of profit centers and another way that Tesla is just going to get bigger, better, stronger, and more valuable. He says they have the Tesla AI Quartet. This quartet will be de-risking the future with 4 synergistic pillars, and he doesn't include my solar panel factory. The synergy multiplier: robotaxi plus Optimus plus autobidder plus robo-trucking. They form the most efficient, lowest cost logistics and labor network imaginable. This is not just diversification. It's a compounding effect that de-risks Tesla's future by creating an interlocking web of businesses no competitor can easily replicate. It's a verticality, it's broad as well as vertical. It's an incredible, incredible concept. So think about it again. Robotaxi plus Optimus plus auto bidder on megapacks, etc., and robo-trucking. Now add in solar panels. Yeah, you got even more cool stuff. Investors Business Daily says that Tesla's Elon Musk over the weekend continued to tout the EV giant's upcoming full self-driving or FSD update. But Elon cautioned that he cautioned that while it will be better than human, 2 to 3 times, he said, it will take months to debug. Tesla shares edged lower before Monday morning stock opening amid an upsurge of attention among traders on Reddit. I don't think Tesla being down slightly this morning had anything to do with Elon saying it will take months to debug. I think it had to do with the market was down because of what I just said above. All right. And it was just down a little. And Tesla was not just down a little because of, I think, buyer's remorse over the Fed thing. What I do think is that the FSD 14 is coming out before the end of September, and it will be better than a human driver, and it will take months to debug. Well, that's what they're doing. They've been debugging it. And so I don't think he means more months. I don't think he means October, November, and then we get it in January. I mean, yeah, I think he's talking that it's taking months to debug. Musk posted on next Saturday that FSD version 14, which he said should launch in September, will be about 2 or 3 times better than a human driver. Version 15 could be 10 times superior, he said. However, Musk appeared to backtrack that statement early Monday. Musk wrote Monday that there's so many rare situations in real life that even version 14, while capable of being much safer than a human driver, will take a few months to debug post-release. Separately, Musk on Sunday boasted of his vision of how humanoid robots will transform society in coming years. Tesla continues to work on humanoid Optimus robot. He says, quote, intelligent robots in humanoid form will far exceed the population of humans. He always said 2 to 3 bots per human. There will be universal high income, not merely basic income, universally high income. And everyone will have the best medical care, food, home, transport, and everything else. All the basics will be covered. And we'll explain all of that in great detail in the upcoming book, which has no title, by the way, but we'll work on that. You'll help us out. Yes, I'm going to ask you to help us title the book coming up here in about a week or so. I'll help you. I'll ask you to help me with the title. So these comments came as Musk and Tesla have continued to focus on the autonomous driving and expanding the robotaxi ride-hailing service instead of targeting new vehicles to add to its aging lineup. Tesla shares edged down around 0.5 before Monday's opening after jumping 6.2 on Friday. Percent that was, not dollars. Rebounded from its 50-day moving average, reclaiming the 200-day line, and breaking the downtrend of a handle, offering an aggressive entry point. Reflecting the retail and investor interest in Tesla, Tesla stock was one of the top tracked by the subreddit investor group called Wall Street Bets. Website Ape Wisdom showing Tesla as the 6th top trending issue on our Wall Street's bets as of Monday. Tesla stock enters Monday's stock market up 10.3% in August, trading up with that trading in a cup with handle base. The handle offers a traditional 348.98 buy point, according to Market Surge, and the current base formed with a much larger consolidation. There you go. I don't know what they just said, but some of you are probably interested in that. The relative strength line has lagged since late May and the end of last year, reflecting lagging Tesla performance versus the S&P 500. Tesla earnings are also on track for the 3rd straight annual decline. Maybe not, as I explained Sunday morning in a video that if you haven't seen it yet, I will recommend you do go back, and I'll put that up here at the close. In late July, Tesla undercut its 50-day and 200-day moving averages as Musk warned of a few rough quarters ahead in his Q2 conference call. And I've reversed that now. I think Q3 and Q4 are going to be amazing. Q1, who knows? Maybe that'll be a rough quarter. We'll see. As of Friday's stock market close, Tesla stock was up around 43% since the April 22 Q1 conference call lifted by robotaxi bets. Shares are down about 16% for the year. Again, who cares about what they are for the year? Below their all-time high and they're 30% below the all-time high. Tesla stock has a 21-day average to range of 3.79%. The ATR metric available in IBD's market share charting tool, gauges the characteristic breadth of a stock's behavior. Stocks that tend to make large jumps or dives in daily stock market action, the kind that trigger sell rules and shake investors out of stock, have a higher ATR. Stocks that tend to make more incremental moves have a lower ATR. Tesla stock has a 56 composite rating out of a possible 99 and a 68% relative strength rating and a 54 EPS rating. Again, I'm reporting those to you without being able to comment because I don't know what any of it means, but you might, and you might care. Morningstar says declining sales coupled with controversies generated. Elon Musk is creating controversies. Tesla stock sharply lower in 2025. Still the manager of the stock fund that has owned Tesla shares since shortly after the 2010 IPO believes a turnaround is not far off. That's not me. That's Joseph Dennison, is a manager of the $560 million Virtus Zavenberger Innovative Growth Stock Fund, which goes by the call SCATX. The fund has a 7.3 allocation for Tesla, making the stock its fourth largest holding. This is one of the largest weightings to Tesla of any diversified activity managed U.S. stock fund. Dennison argues that Tesla has weathered tough times and sharply negative investor sentiment. He thinks the increasing importance of autonomous vehicles and Tesla's rollout of new, more affordable models should help fuel a 2026 revival. While Tesla stock is up from its worst levels of the year, it's down to 20% so far in 2020. Dennison doesn't share the market's downbeat view. The future of transportation is electric and autonomous, and there's no company better positioned to capitalize on that possibility than Tesla. Turns out these guys are very, very successful. They're in the upper 1% of all funds of their type. Tesla, Dominion, here it is. Dennison has built has been a portfolio manager for a decade, and it is highly concentrated growth stock fund that holds 35 to 40 stocks. 27th percentile of large cap growth category over the past 10 years, returning an average of 15.8% a year. With the concentrated growth strategy, the fund's returns have been volatile. For example, it lost 55% in 2022, who didn't, and putting it in the 99th percentile in its category before it gained 66% the following year, catapulting it back to the 1% level. Interesting. I just thought you'd like to know who is making the comment, that Tesla is going to blow it up again in 2026. I don't know who's been saying 2026 since April of 2023. A true-blooded, this is Randy Kirk, by the way. That's what it says. I'm supposed to do the introduction right now. It's Randy Kirk. Like, subscribe, notify. My subscriptions are not coming in very good this month. Are you subscribed yet? Why not? Just subscribe. It won't hurt you. Hitting the like button also helps the algo. And I did get a new person this morning on let's see here. Just a second. I'm gonna, I got to do this. I can't always forget to do this. Neil N. No, is that right? No, George G. Joined this morning. Joined Patreon. Thank you very much, George G. More of you need to do that. A true full-blooded conservative will say that government should never, ever, ever get involved in businesses that the private sector can handle. That would include a move like buying 10% of Intel, for instance. The record should show, however, this is Randy talking now, no newspaper or magazine or anybody else. The record should show that the U.S. government has gotten involved for strategic reasons, for financial reasons, and even for ideological reasons in businesses since I've been born and before that. Think of U.S. Steel. Think of General Motors and Chrysler. Think of Too Big to Fail. Think of the CHIPS Act, and so many more examples. Well, which do you think would be the smartest way? If the United States government is going to do it anyway, which of these four methods would you think would be the better way to do it? Do you think that we should loan money to companies like we did GM and then hope they don't go bankrupt or fail to pay us in the future? Or do you think we should give companies money in grant form and just kiss it off and just, here you go, guys, thank you very much? Or do you think we should use, government subsidies like we've seen for all kinds of industries? Again, putting our finger on the scale that helps those industries. And in some cases, if it's strategic, I, as a conservative, think that there's reasons in strategic cases like Intel that it might be a good idea to do it. Or do you think, number four, that we buy the company's stock and then the U.S. government gets something, the U.S. government, you and I, get a tangible asset that may pay us huge dividends in the future? Which one of those things do you think is the smartest way? Let me know in the comments below. Wall Street Journal this morning says, last week, Federal Reserve Chairman Jerome Powell said that the U.S. labor market has entered a kind of curious balance. The demand for workers has cooled, yet the unemployment rate is held steady because the supply of labor has slowed. Behind the slowing in the labor supply is a dramatic swing in immigration. From one of the biggest waves in U.S. history to almost none. Economists say that could have subtle but lasting consequences. Subtle, a virtual halt to unauthorized border crossings, plus stepped up deportations and a souring climate for foreigners means net immigration this year could be negative for the first time in decades, some experts predict. They watch my show, they just copy, they just take notes, and then they write an article and they take credit for it. That has a short-run benefit, as Powell alluded to. It means slumping labor demand won't necessarily push up the unemployment rate, which is 4.2% and historically low. But in the long run, it could limit the economy's potential growth and generate larger budget deficits. No, it could limit the economy's potential growth, but it won't generate larger budget deficits. Necessarily, it might, but it won't. From 2010 to 2019, a net 917,000 people entered the country annually on average, according to the Congressional Budget Office. This leapt to 3.3 million in 2023 and 2.7 million in 2024, one of the biggest such surges in American history. And by the way, these numbers are probably all wrong anyways, probably many times more than this. In a recent paper for the Conservative American Enterprise Institute, economists Wendy Edinburgh, Stan Vauger, and Tara Watson estimated that migration will drop to a negative 205,000 this year, give or take roughly 250,000. So it could be break even or it could be 500,000 negative. They attribute this to the combination of minimum illegal immigration and a surge in out-migration. And some people criticize me for using the word out-migration. This is not good. I think I froze there for a minute, so I don't know what happened, but hopefully it's okay. A surge in out-migration between 675 to 1.02 million above typical rates, assuming increased deportations and voluntary departures. I think it'll be more than that. The last time annual net immigration was consistently so low was in the 1960s, but back then the baby boomers were making up for that, and you didn't have the baby boomers dying off. Economists and demographers say immigrants already account for the vast majority of growth in both the population and the labor supply. We've been saying this for weeks, months. With zero net immigration, Apollo chief economist Torsten Slok estimates the U.S. economy would be able to sustainably add only about 24,000 non-farm jobs a month, compared with an average of 155,000 from 2015 through 2024. So watch for that. I've been saying this how long? So under 50,000, under 40,000, maybe some negative months. And it won't mean we're going into a recession. It just means we don't have any laborers and that we do have softness in the labor supply, primarily because of AI rather. Not everyone expects a net outflow. Goldman Sachs forecasts net immigration to stabilize about 500,000 a year, in part because of the difficulty of further scaling up deportations. I don't think they're right. But I do think that President Trump will eventually say, "Okay, that's enough." You've heard me say it. I'm going to keep saying it. There's going to be a point where President Trump, now maybe after the next year's November elections, but sometime he's going to go, "Okay, that's enough," and we're going to ask Rubio over here, who's got experience in doing this, to put together a bipartisan plan to just call it off, call it even. We've got the wall, got the big, beautiful wall. And then we're going to say, okay, if you're here and you're not a criminal and you've been a good citizen, and we're going to find a way. The actual flow of immigrants and emigrants is impossible to measure precisely in real time. The U.S. doesn't keep comprehensive records on people who deport the country, and the Trump administration has stopped publishing regular data on deportations. People living here illegally might enter and exit without leaving any statistical trace. There have been claims that the net immigration has already turned negative, such as a report by the Pew Research Center this last week. Secretary Kristi Noem said 1.6 million unauthorized immigrants left the U.S. in her first 200 days on the job. Spokesperson Tricia McLaughlin said in an email that figure comes from our own numbers, but didn't provide details. Anyway, I think that's enough of that. I think that's you get it. All right, let's end that one and go on to the next one. Fortune magazine. Moody's Analytics chief economist Mark Zandi continued to sound the alarm on the risk of a downturn, warning that states accounting for nearly 1/3 of U.S. GDP are already in recession, are at high risk of dipping into one. Meanwhile, another third is treading water, while the last third is still expanding. Last week's Andy, now I'm giving you, I don't believe anything that he's saying, but I think it's good to always give the other side. Last week's Andy also put a finer point on his forecast. He says Moody's machine learning-based leading recession indicator puts the odds of a recession at 49% in the next 12 months. While tax cuts and government spending on defense should help growth, that won't come until next year. I don't know why. The base case is that the economy avoids a recession, but not by much, according to Zandi. The economy will be most vulnerable to the recession towards the end of this year and early next year, he added. That is when the inflation fallout of the higher tariffs and restrictive immigration policy will peak, weighing heavily on real household incomes and thus consumer spending. With the economy facing many threats, it wouldn't take much to push into a recession, Zandi said, singling out a sell-off of the Treasury bond market that would send long-term yields soaring. That's the last thing that I would expect to happen in that circumstance. What I do think is that, that none of this is correct. And before that, he pointed out more than half of the industries are already shedding workers, a sign that's accompanied past recessions. But there's so many things that he's missing on this. They're shedding workers that they were warehousing, and they're not going to warehouse those workers anymore. Slowly but surely, they're getting down to a level that makes sense for their companies. They've also got AI coming in, and that's another impact. And that's going to be a good impact because it's going to have productivity. Both of those things are going to increase productivity. Payrolls expanded to 73,000 last month. We just talked about that. This is where we're going to be. Because recent revisions have been consistently much lower, Zandi said he wouldn't be surprised if subsequent revisions show that unemployment is already declining. This could be true. They're talking about another huge revision, which could show that we had declining zero or very low numbers even under the last half year under Biden. Also telling us that unemployment is declining in many industries. Employment is declining in many industries. In the past, if it fell in more than half of the 400 industries in a payroll survey, we were in a recession. Yeah, but this is not regular times, and he needs to keep that in mind. Okay, this is that breaking news with regard to the housing numbers. Sales, now you got to pay very careful attention to this. Sales of new single-family houses in July 2025 were a seasonally adjusted annual rate of 652,000, which, according to the U.S. Census Bureau, this is 0.6%, only 0.6% below June, but it's 8.2% below last July. For sale inventory, now listen, for sale inventory and month supply, the seasonal adjusted estimate of new houses for sale at the end of July was 499,000. That is 0.6% below June and 7.3% above last July. These are not big numbers. I thought the supply would be much bigger than this. It's only 7.3% above last year's number. This represents a supply at 9.2 months, which is way more than it was. It was around 3 to 4 months, but believe me, it's been higher in the past. The month supply is virtually unchanged from June, but it's 16.5% higher than July of last year. Sales price, the median sales price of new houses sold in July was 403,800. That is 0.8% below June and 5.9% below the July last year. The average sales price of new houses sold in July was 3.6% below June and 5% below last July. So both the median and the average, both below last year. This is extremely good news for inflation, even though, as you know, everybody will point out, well, it'll take months before we see that in the CPI, et cetera. And that's true. Well, Truflation says overnight their number is 2.08. Year over year, their number is 2.01. Sounds good to me. Trump is now at 50% approval, meaning he moved all the way from 47% at the end of last week, all the way up to 50% during the course of this week. And the GDP tracker right now, of course, sits at 2.3. We'll get a new number, I think, on Wednesday. All right, let's take a look at where the markets are right now. We have got Tesla up 0.23 at $340.80. We got the Dow down a tad at 0.42. We've got the NASDAQ up 0.10 and the S&P up down 0.15. Magnificent Seven are mostly up with Meta and Microsoft. Microsoft is down 0.000%. And Nvidia up a little bit, 0.85. We've got the VIX down. So I think it was that housing report. You can just see it was going along and it went like this. The VIX dropped to 14.6. This is extremely bullish. We have got the Cathie Woods are mixed with mostly down, but also all the ones that are down are trending up toward the green. So I think, again, everything changed when the housing number came out. All right, let's go ahead and look at bonds, I think, which were heading up. And you'd think that the bonds would head down after that report, but they didn't. They're up 3.5 basis points, just under 4.3 at 4.293. That is disappointing. Oil price, but I think that's buyer's remorse. Oil prices up this morning 98 cents to 64.65. You've got a natural gas up 0.22% at $2.70, still really, really low compared to the last 6 months. We've got gold at 3,416. It's down a little bit, just a tad, call it almost unchanged. You got silver down 0.54%, 38.85. Again, really close to all-time highs on both of those. Copper up 0.67, $4.49. Pretty close to pretty flat for the last couple of weeks. You got the dollar mixed, and you've got Bitcoin down another 1,100 to 112,000. So there you go. Those are the numbers. Later on today, Larry Goldberg, almost certainly, as far as I know. Larry will be here. Brian White for sure at 7:45. If you haven't hit like, do all that now. Remember, yesterday morning, I gave you 10 reasons why Tesla's going to the moon. And everybody seemed to like that video quite a lot. So I'll put the card up right here. Yeah, I think that's all I have for you. Oh, you want me to look one more time just to see if Tesla's still going up? I'll check that out. Let's see here. We have got Tesla, whoops, back into the red just a tad, 0.04 negative at 339.87 cents. But it's what the market seems to be doing now is this. I think we're going back to Nvidia watch. I think that's what's going to happen today and tomorrow. We're in Nvidia watch. Like last week, we're in Fed watch. Today and tomorrow, we're going to be in Nvidia watch. I don't think we'll be in PCE watch for the rest of the week, but I do think we'll be in Nvidia watch until tomorrow night. All right, that's all I got. It's been great talking to you.